Hello and welcome back to the Investing Iguana. I'm your host, Iggy. Today, we're going to delve into a fascinating trend that's been emerging in Singapore's investment landscape. It appears that more than half of Singapore's wealthy investors are shifting their focus towards safer assets. But why is this happening? What's driving this trend? And most importantly, what does this mean for you as an investor? Stay tuned as we unpack these questions and provide insights that could potentially shape your investment strategy. Whether you're an experienced investor or just starting out, this is a discussion you won't want to miss. So, let's dive right in. In the heart of Singapore, a city known for its dynamic economy and discerning investors, over half of the affluent individuals are shifting gears towards more secure investments like cash and gold. This trend reflects a cautious approach to the unpredictable stock markets and ventures with higher risk factors. The latest insights from Swiss private bank Lombard Odier reveal that 56% of Singaporean high net worth individuals, HNWIs, are broadening their investment horizons, especially in these times of global economic challenges. Compared to the average 41% across Asia-Pacific, a notable 53% of Singapore's wealthy are leaning towards these safer assets. Francis Liu, the CEO for private clients in Asia at Lombard Odier, interprets this not as a full-blown rush to safety but as a reluctance to embrace riskier avenues such as digital assets and the fluctuating equity markets. He pointed out that while HNWIs, those with at least $1 million (1.36 million Singapore dollars) and investable assets, recognize the importance of diversifying their portfolios, actual implementation remains a challenge. This intriguing study surveyed over 460 HNWIs across Singapore, Hong Kong, Japan, Thailand, the Philippines, Taiwan, and Australia, focusing on their personal and wealth-related ambitions within a family context. The survey delved into various personal aspirations, including lifestyle maintenance, safeguarding family wealth, investment strategies, entrepreneurship, sustainable investing, and philanthropy. In Singapore, the high net worth individuals, HNWIs, or the elite class, place a significant emphasis on maintaining their existing lifestyle. This is a trend that is quite prevalent among this group. They are more interested in preserving their wealth and ensuring a comfortable and luxurious lifestyle for themselves and their families. Interestingly, only about 15% of these individuals consider starting a business as a key goal. This is the lowest percentage in the region, suggesting that entrepreneurship is not a top priority for Singapore's wealthy class. They may prefer to invest in established businesses or other forms of investments rather than taking on the risk and challenges associated with starting a new business. Sustainable investing is a topic that is gaining momentum globally, and it resonates with approximately 30% of Singapore's HNWIs. These individuals are increasingly aware of global issues such as climate change and food security, and they understand the role that sustainable investing can play in addressing these challenges. However, there is a degree of skepticism about the financial returns from such investments, which acts as a barrier to their action. They may have concerns about whether sustainable investments can provide the same level of return as traditional investments. A similar hesitancy is observed when it comes to investments in private assets. These are investments that are not listed on public markets and typically include ventures linked to the government. Despite the potential for high returns, there is limited confidence and understanding in this domain among Singapore's HNWIs. This lack of familiarity and understanding can make these types of investments seem more risky, deterring potential investors. The trend of more than half of Singapore's wealthy individuals gravitating towards safer assets like cash and gold can be attributed to a confluence of factors, particularly relevant in the context of Singapore's economic and financial landscape. 1. Global economic uncertainty. The past few years have indeed been characterized by significant global economic uncertainties. Factors such as geopolitical tensions, trade conflicts, and the aftermath of the COVID-19 pandemic have created a challenging environment for investors worldwide. Geopolitical tensions often lead to market volatility as they can disrupt international trade, create supply chain issues, and impact consumer and business confidence. Trade conflicts, such as tariffs and trade wars, can also create uncertainty as they can lead to changes in import and export costs, impacting the profitability of businesses and the prices of goods and services. The COVID-19 pandemic has had a profound impact on the global economy, causing widespread disruption and leading to recessions in many countries. The pandemic has affected various sectors differently, with industries like travel and hospitality being particularly hard hit. In response to these uncertainties, investors have been seeking stability in their investments. This has led to a preference for assets like gold and cash, which are traditionally seen as safe havens during volatile times. Gold is often viewed as a store of value that can provide a hedge against inflation and currency fluctuations. Cash offers liquidity, allowing investors to quickly access their funds when needed. 2. Market volatility. The equity markets have experienced heightened volatility, driven by various factors such as fluctuating interest rates, uncertain global growth prospects, and disruptive technological advancements. This volatility can be daunting for investors, especially those who prioritize wealth preservation over high-risk, high-reward investments. 3. Diversification strategy. Wealthy individuals, often having a deep understanding of financial markets and investment strategies, recognize the importance of diversification in their investment portfolios. Diversification, the practice of spreading investments among different types of assets and sectors, is a key strategy for managing risk and potential returns. By including more stable assets like cash and gold in their portfolios, these individuals are taking a proactive approach to wealth preservation. Cash and gold are considered safe haven assets, meaning they tend to retain or increase in value during market downturns. Cash provides liquidity, allowing investors to take advantage of new investment opportunities as they arise, while gold is often seen as a hedge against inflation and currency fluctuations. 4. Inflation concerns. With concerns about inflation, particularly in a post-pandemic economic recovery phase, assets like gold are often viewed as a hedge against inflation. Gold has historically maintained its value over time, making it an attractive option for those wary of inflation eroding their purchasing power. 5. Technological and digital asset skepticism. The advent of digital assets, such as cryptocurrencies, has indeed garnered global attention. These digital assets represent a new frontier in the financial world, offering unprecedented opportunities for high returns. However, they also come with their own set of challenges. Cryptocurrencies are known for their high volatility. Their values can fluctuate wildly within short periods, leading to potential for both significant gains and substantial losses. This volatility stems from a variety of factors, including market speculation, regulatory news, technological advancements, and macroeconomic trends. In addition to volatility, regulatory uncertainties also surround the world of cryptocurrencies. Different countries have different regulations regarding the use, trade, and taxation of cryptocurrencies. Some countries have embraced them, while others have imposed strict regulations or outright bans. These regulatory uncertainties can add another layer of risk to cryptocurrency investments. For conservative investors, particularly Singapore's wealthy who prioritize capital preservation, these characteristics can make cryptocurrencies less appealing. The focus of these investors is often on maintaining and growing their wealth steadily over time, rather than chasing potentially high but risky returns. The unpredictable nature of cryptocurrencies, coupled with the potential for sudden losses, may not align with their investment goals and risk tolerance. 6. Real estate market cooling measures. In Singapore, the government has taken proactive steps to regulate the real estate market, implementing various cooling measures to prevent speculative investment and overheating. These measures are designed to maintain a stable and sustainable property market, protecting both investors and homebuyers. Real estate has traditionally been a popular investment among the wealthy. It's often seen as a tangible asset that can provide steady returns through rental income and potential appreciation in property value. However, the cooling measures introduced by the Singapore government might have changed this perception. These measures include additional buyer's stamp duties, tighter loan-to-value limits, and restrictions on the number of properties one can own. They aim to discourage speculative buying and selling, which can lead to property bubbles and market instability. While these measures protect the overall health of the property market, they also increase the cost and complexity of real estate investment. As a result, real estate, once a go-to investment for Singapore's wealthy, might become less attractive. The increased costs and restrictions could lead these investors to consider other safe assets like cash and gold. Cash offers liquidity and flexibility, while gold is seen as a safe haven that holds its value during economic downturns. 7. Legacy and succession planning. For HNWIs, especially those considering legacy and succession planning, preserving wealth through safer investments is often a priority. Investments in assets like cash and gold are seen as more stable and less prone to rapid devaluation, making them suitable for long-term wealth preservation and intergenerational wealth transfer. The Lombard Odier report highlights that while Asia-Pacific-focused private equity funds outperformed public markets in 2022, private assets are not universally suitable due to their long-term and illiquid nature. However, for those capable of pursuing a multi-year investment strategy, they form a crucial component of a diversified portfolio. The report also sheds light on a common reluctance among Singapore's affluent and their regional counterparts in articulating personal goals and transforming thoughts into actions. A significant 60% perceive differing objectives between themselves and their family members. Vincent Magnanat from Lombard Odier pointed out a discrepancy between the high net worth individuals' intentions and their actual decisions, particularly in achieving personal goals, sustainable investing, handling private assets, and aligning family objectives. Such unresolved issues can lead to poor financial choices, losses, or increased costs. Moreover, the study highlights a generational divide in outlooks, particularly relevant as an estimated $2.5 trillion is anticipated to be transferred to the next generation in the coming decade by about 70,000 HNWIs in the region. Younger individuals under 45 tend to prioritize property ownership, investing in their businesses, or enhancing their lifestyle. Interestingly, women place higher importance on lifestyle improvement, sustainability, and wealth transfer to children than men, indicating varied investment perspectives across genders. And that brings us to the end of our discussion today on why more than half of Singapore's wealthy investors are leaning towards safer assets. We hope this episode has provided you with valuable insights and a deeper understanding of the current investment trends in Singapore. Remember, investing is not a one-size-fits-all strategy. It's about understanding the market dynamics, assessing your risk tolerance, and making informed decisions that align with your financial goals. If you enjoyed this video and found it informative, please give it a thumbs up, share it with your friends, and don't forget to subscribe to the Investing Iguana for more investment insights from around the globe. Thank you for tuning in, and as always, happy investing. Until next time, this is Iggy, signing off.